Wednesday, February 25th, 2026, 12:15 p.m. Central Time. Silver is trading at $91, building momentum toward $92 resistance. Then everything stops. The CME Group halts all metals trading. Official reason? Technical issues. But here's what they're not telling you. This is the second major disruption in 3 weeks after half a decade without outages. The halt happened exactly 48 hours before March 1st notice day, the moment when 500 million ounces of paper silver contracts faced just 87 million ounces of physical metal in COMEX vaults. When trading resumed 100 minutes later, silver had dropped $3 to $88 in pure, coordinated selling pressure. This wasn't a glitch. This was intervention. And I'm about to show you the proof. Hi, I'm Roxanne, and what you're about to see is the most comprehensive breakdown of systematic silver market manipulation ever documented on YouTube. We're going to walk through 8 years of proven criminal activity, $920 million in fines paid by JPMorgan alone, 2 traders who went to federal prison, and the unprecedented market crisis happening right now in February 2026. That's forcing the largest financial institutions on Earth to pull emergency levers they swore they'd never touch again. This isn't conspiracy theory. This is court documents. This is CFTC enforcement actions. This is exchange data published daily that anyone can verify. And by the end of this video, you'll understand exactly why silver is the most manipulated market in modern financial history, and why that manipulation is breaking down in real time. Let's start with what's not disputed. Between March 2008 and August 2016, JPMorgan Chase, the largest bank in the United States, engaged in systematic manipulation of precious metals futures markets. This isn't alleged. JPMorgan admitted to it. September 2020. The Commodity Futures Trading Commission orders JPMorgan to pay over $920 million, the largest penalty in CFTC history. The Department of Justice adds criminal charges. JPMorgan enters a deferred prosecution agreement, admitting that traders on its precious metals desk in New York, London, and Hong Kong engaged in a scheme to defraud for 8 straight years. Here's how the scheme worked. It's called spoofing. JPMorgan traders would place massive orders to buy or sell silver futures contracts, orders worth millions of ounces, with zero intention of actually executing them. These fake orders would appear in the market order book where every other trader could see them. The fake orders created the illusion of massive buying or selling pressure. Other traders would see these orders and react, moving their own orders to chase the apparent market movement. Then, milliseconds after the genuine orders from other traders were filled, JPMorgan would cancel their fake orders and walk away with profit. The CFTC order documents specific examples. March 5, 2014, 8:18 a.m. A JPMorgan trader places a genuine order to sell 2 lots of silver futures at just over $21 per ounce. Less than 1 second later, he enters 10 layered spoof orders on the buy side, ranging from $21.25 to $21.27. Milliseconds after his 10th fake buy order hits the market, his genuine sell order is completely filled. He immediately cancels all the fake buy orders. The entire sequence took less than 2 seconds. This happened tens of thousands of times. The CFTC found that JPMorgan's illegal trading generated $172 million in profits, while causing $311 million in losses to other market participants. The scheme wasn't limited to silver. JPMorgan spoofed gold, platinum, palladium, and U.S. Treasury futures simultaneously. And here's the critical detail most people miss. The heads of both the precious metals desk and the Treasury desk were directly involved. This wasn't rogue traders. This was institutional strategy running from at least 2008 through 2016, with management knowledge and participation. August 2022. 2 JPMorgan traders were convicted in federal court. Michael Nowak, the head of JPMorgan's global precious metals desk, and Greg Smith, an executive director. Both were sentenced to federal prison in August 2023. Nowak got 1 year and 1 day plus a $35,000 fine. Smith got 2 years plus a $50,000 fine. These are the only 2 precious metals traders in modern history to serve federal prison time for market manipulation. And they worked for JPMorgan. JPMorgan wasn't alone. Between 2016 and 2025, 8 major banks paid over $1.3 billion in fines for silver market manipulation. Scotiabank paid $127 million in a settlement with the DOJ in August 2020, plus an additional $232 million Canadian in reserves disclosed in their quarterly filings. Their total cost exceeded $360 million. The losses were so severe that Scotiabank completely exited the precious metals trading business in 2021. Deutsche Bank settled for $38 million in 2016 for conspiring to fix silver prices. The bank was accused of coordinating with other banks to manipulate the silver fix, the benchmark price used globally to settle contracts. UBS and HSBC paid a combined $47 million in fines in 2018 for deceptive trading practices in precious metals. Barclays was fined £26 million by the UK Financial Conduct Authority in 2014 for failings connected to the London gold fixing, which also affected silver pricing mechanisms. This is $1.3 billion in documented fines for criminal activity spanning from 2008 to 2020 in a single commodity market. The manipulation was systematic, coordinated, and institutional. Now let's fast forward to November 28, 2025. This is the event that set the template for what just happened this week. Silver is trading at $53 per ounce on the morning of November 27th. Price is building momentum. That day is first notice day for the December silver contract, the deadline when contract holders must declare their intention to take physical delivery. Reports surface that a Chinese industrialist has notified COMEX of his intent to take physical delivery of 30 million ounces of silver. That's 30 million ounces of paper contracts demanding to become physical metal. At 9:44 p.m. Eastern Time on November 27th, CME announces via Twitter, "Due to a cooling issue at CyrusOne data centers, our markets are currently halted. All metals trading stops. The halt lasts 10 hours. Here's the official story. CyrusOne's facility in Aurora, Illinois, a 450,000 square foot data center that CME sold to CyrusOne in 2016 for $130 million in a sale-leaseback deal, experienced a chiller plant failure affecting multiple cooling units. 10 hours on first notice day, while a 30 million ounce physical delivery demand sits pending. When trading resumes on November 28th, silver immediately spikes to an all-time record high of nearly $57 per ounce. Then, over the next 2 months, silver more than doubles to $121 per ounce by late January 2026. The move was historic, a 127% gain in 60 days. But here's what happened behind the scenes during that 10-hour blackout. JPMorgan pulled 13 million ounces of silver off the COMEX. The Chinese industrialist was left scrambling to cover his shorts with physical metal sourced from China. The cooling failure gave the market time to reposition before the delivery pressure became unmanageable. CME's explanation? Technical difficulties. The timing? Pure coincidence. Which brings us to Wednesday, February 25th, 2026. Silver is trading at $91. Price has broken through resistance at $87 to $89 and is building momentum toward $92, the next technical target. March 1st notice day is 48 hours away, February 27th. Here's the setup. March 2026 open interest represents approximately 500 to 528 million ounces of silver. That's paper contracts. COMEX registered silver inventory, the actual physical metal available for delivery, stands at just 87 million ounces as of February 24th. That's a ratio of nearly 6 to 1. 6 ounces of paper promises for every 1 ounce of deliverable metal. 12:11 p.m. Central Time. CME's Global Command Center acknowledges technical issues. By 12:15 p.m., a full trading halt is confirmed. Natural gas futures and metals futures both go dark. Natural gas resumes trading at 12:50 p.m., a 35-minute halt. Metals don't reopen until 1:45 p.m. That's 90 to 100 minutes of frozen markets. During the halt, all-day orders and good-till-date orders placed for Wednesday are canceled. Only good-till-canceled orders with prior confirmations stay in the system. This resets the order book in a way that favors institutional players who can react instantly over retail traders still figuring out what just happened. When trading resumes, silver drops $3 in minutes, from $91 to $88. Not gradual. Immediate selling pressure that looks coordinated, not organic. Silver is now back at $89, holding former resistance as support. But here's the data that matters. This is the second major CME disruption in 3 weeks. First week of February, settlement prices were delayed across metals. Now, a full trading halt. Before November 2025, CME had gone half a decade without major outages. Now we've had 2 in 3 months, both occurring when silver was approaching breakout levels near critical settlement dates. The official CME explanation? Technical issues. No further detail, just a status page reading investigating. Let's talk about why these halts keep happening right before settlement. COMEX registered silver fell over 2 million ounces on Tuesday, February 24th alone. The breakdown shows withdrawals from every major vault. Asahi withdrew 1.55 million ounces. HSBC pulled 647,000 ounces. JPMorgan withdrew 374,000 ounces. Brinks adjusted 167,000 ounces out of registered status. Stonex withdrew 80,000 ounces. Every single day, registered inventory declines. As of February 25th, we're at 87 million ounces. And some reports show it's already dropped below 85 million. Now, cross that against open interest. March 2026 silver futures represent approximately 500 million ounces. If even 20% of contract holders stand for delivery, a conservative assumption during market stress, that's 100 million ounces of delivery requests against 87 million ounces of available inventory. But here's the part most commentary misses. Not all of that registered silver is equally accessible. Physical ownership within CME vaults is not distributed evenly. Some of those 87 million ounces are held in concentration by specific institutions. When delivery pressure concentrates against specific short positions, the aggregate numbers become irrelevant. You can have delivery failures even when top-line inventory appears adequate. February 2026 is not even a major delivery month. Historically, February sees 1 to 5 million ounces delivered. This February, between 33 and 40 million ounces delivered in the first 2 weeks alone. Some estimates put the full month at 49 million ounces. That's a delivery rate approaching 98%. This isn't a futures market where contracts roll forward. This is a physical allocation mechanism. While Western markets are halting, Shanghai is screaming. Shanghai Futures Exchange silver closed at around $102 per ounce on February 25th. Western spot silver is trading at $90. That's a $12 premium, a 12 to 13% difference. When physical silver in Asia trades at this kind of premium over Western paper prices for multiple consecutive sessions, that's not temporary arbitrage. That's structural dislocation. It means the price being quoted on COMEX and LBMA has increasingly little relationship to what actual buyers are paying for physical, deliverable silver. China isn't alone. Japan saw secondary market premiums surge to 60% on platforms like Mercari in late 2025. India's major mutual funds, Tata, Kotak, SBI, and UTI, temporarily suspended new lump sum subscriptions in silver ETFs in October, due to high physical premiums and limited LBMA-certified bar availability. And here's the enforcement signal. Shanghai Futures Exchange suspended 25 trading groups in February alone for violating position limits and breaching exchange trading rules. You don't suspend 25 accounts in a single month unless something genuinely abnormal is happening in position sizing or risk concentration. Exchanges don't act preemptively. They act reactively when concentrated positions threaten delivery integrity or market stability. Silver lease rates tell the story Western headlines won't. Under normal conditions, 1-month silver lease rates hover around 0.3% to 0.5%. By January 2026, rates had exploded to 8%. In October 2025, London silver lease rates spiked as high as 39% intraday, before moderating to 11%. What does this mean? A lease rate is the cost of borrowing physical silver. When someone is willing to pay 8% annualized, or 39% at peak, just to borrow silver for short-term delivery, it means physical supply and demand are severely out of balance. Elevated lease rates crush cross-market arbitrage opportunities. They send a blunt message. Even if silver feels expensive, you still have to chase it, because having no silver is more lethal than silver being too expensive. The futures term structure confirms it. Starting in late 2025, silver futures flipped into backwardation. Nearby contracts became more expensive than deferred contracts. When the curve inverts like this, it signals that silver you can take delivery of right now is far more valuable than silver promised months in the future. Now layer in a supply crisis. Mexico is the largest silver-producing country on Earth. It supplies 50% of all silver imported into the United States. Not a significant portion, half. A few days ago, 10 workers from a mining company were abducted in Mexico. 3 were found dead. The incident has triggered immediate operational consequences. Mining companies are struggling to attract and retain employees in affected regions. Security costs have surged. Transport of silver ore and refined metal is facing active disruption. The United States recently declared silver a critical mineral for the first time in history. The designation wasn't symbolic. It reflects documented demand from AI infrastructure build-out and defense applications, both of which require silver and neither of which has a near-term substitute. When a commodity that's already in its 5th consecutive year of supply deficit faces active supply disruption from its dominant source, markets don't absorb that risk neutrally. They reprice violently. Let's connect the dots. November 28, 2025. CME halts trading for 10 hours on first notice day due to cooling failure. Silver at $53. Reported 30 million ounce delivery demand from Chinese industrialist. Trading resumes. Silver spikes to $57. Then rallies 127% to $121 over next 60 days. February 25, 2026. CME halts trading for 100 minutes, exactly 48 hours before March 1st notice day. Silver at $91, approaching $92 resistance. March open interest, 500 million ounces. Registered inventory, 87 million ounces. Trading resumes. Silver drops $3 immediately to $88. Both halts occurred on or immediately before first notice day. Both happened when silver was testing key resistance levels. Both came when delivery pressure was building against concentrated short positions. Both took place when registered inventory was declining daily without replacement inflows. And both happened after half a decade of stable CME operations. The official explanations? Cooling issues in November. Technical issues in February. Jesse Livermore wrote in Reminiscences of a Stock Operator, "When you control the exchange, you control when trading happens and when it doesn't. A well-timed halt can accomplish what direct manipulation cannot, resetting momentum when pressure builds beyond containment." We are now 48 hours from March 1st notice day. Let me walk you through exactly what we're facing. COMEX registered silver stands at just 87 million ounces, and it's falling every single day. Meanwhile, March open interest represents roughly 500 million ounces of paper contracts. February saw a delivery rate approaching 98%, with between 33 and 49 million ounces delivered in what's supposed to be a non-major month. The Shanghai premium persists at $12 per ounce over Western spot prices. Silver lease rates are running at 8%, compared to normal levels of 0.3 to 0.5%. And Mexico's silver supply is actively disrupted by cartel violence. Now here's the math that matters. If just 20% of March contract holders stand for delivery, that's 100 million ounces demanded against 87 million available. If 25% stand for delivery, you're looking at 125 million ounces. And remember, registered inventory is not evenly distributed across all market participants. Some institutions hold concentrated positions. Delivery pressure can create localized failures even when aggregate numbers look manageable on paper. The February 25th trading halt reset the order book. It gave short positions time to reposition, but it didn't change any of the structural parameters driving the crisis. This isn't the first silver squeeze. In 1980, the Hunt brothers accumulated such massive silver positions that COMEX had to intervene. January 21, 1980, COMEX declared liquidation-only trading. No new positions could be opened, only closed. Silver dropped 30% in 2 days. In 2011, silver rallied from $9 after the 2008 financial crisis to nearly $50 per ounce by April. CME raised margin requirements 5 times in 9 days between April 26 and May 9th. Silver collapsed 30% within weeks. The pattern repeats. Physical pressure builds, prices surge, exchange intervention follows, prices reset. But 2026 is different. The Hunt brothers were speculative. 2011 was post-crisis flight to safety. 2026 is structural. We're in the 5th consecutive year of supply deficit. Annual industrial demand exceeds 650 to 700 million ounces, while mine supply is around 820 million ounces. The gap is filled from inventory or recycling, but inventories are draining. COMEX registered silver has fallen from 168 million ounces in October 2025 to 87 million ounces in February 2026, a 38% decline in 4 months. Solar photovoltaic demand alone consumed 232 million ounces in 2024, up 5-fold from 2015. Electric vehicles, 5G infrastructure, AI data centers, all require silver with no current substitute. This isn't speculative excess. This is demand fundamentally exceeding supply, while paper markets promised metal they don't have. Here's how silver manipulation actually functions in practice. Step 1. Suppress paper price through spoofing and concentrated short positions. Create the illusion of unlimited supply on futures exchanges. Step 2. Accumulate physical metal at suppressed prices. JPMorgan flipped from net short to net long after their 2020 settlement. By December 2025, market data indicated JPMorgan held approximately 196 million ounces in COMEX proprietary positions, plus another 517 million ounces as SLV ETF custodian. Step 3. When physical delivery pressure threatens to expose the paper/physical disconnect, intervene through exchange mechanisms. Margin hikes, trading halts, position limits, or, as with the Hunt brothers, declaring liquidation only. Step 4. Reset the system and repeat. The difference in 2026 is that Step 4 isn't working. The November halt was supposed to relieve pressure. Instead, silver rallied 127% in 60 days. The February halt was supposed to reset momentum. Instead, we're back at $89, holding support with March settlement 48 hours away and registered inventory still draining. Every claim I've made in this video is verifiable. JPMorgan's $920 million fine. CFTC order. September 29, 2020. Available on cftc.gov. Criminal convictions. DOJ press release August 2023. United States versus Nowak and Smith. COMEX inventory data, published daily by CME Group, available at cmegroup.com/delivery_reports. Shanghai Premium, Shanghai Futures Exchange daily settlements, publicly visible. Lease rates, LBMA publishes gold and silver lease rates. Trading halt timeline, CME Global Command Center status updates, Bloomberg terminal data. Mexico supply disruption. CNN report February 22, 2026. Multiple Mexican news sources. The information has never been hidden. It simply requires the willingness to look at primary sources before someone else packages it into a narrative. Let me walk you through the 3 possible outcomes for March settlement. Scenario 1. Orderly settlement. In this scenario, March contracts roll forward voluntarily or settle in cash. Registered inventory holds above 80 million ounces. The Shanghai premium narrows. Lease rates moderate back toward normal levels. Silver consolidates between $85 and $95 through the second quarter of 2026. The probability of this scenario is low. February's 98% delivery rate and the persistent Shanghai premium suggest physical demand isn't moderating. Scenario 2. Managed squeeze. In this scenario, deliveries exceed registered inventory by 10 to 20%. The exchange intervenes with margin hikes or position limits. Short covering drives silver to $100 to $120 over 30 to 60 days before consolidation. The system stays intact, but credibility is damaged. The probability of this scenario is moderate. This is basically the November 2025 playbook repeated with slightly higher stakes. Scenario 3. Structural break. In this scenario, deliveries exceed registered inventory by 30% or more. The exchange cannot source physical metal to fulfill obligations. Force majeure is declared, or cash settlement is imposed against contract holders' wishes. Physical silver decouples from paper pricing. Eastern markets like Shanghai, India, and Japan become the primary price discovery mechanisms. Western paper markets lose credibility permanently. The probability of this scenario is unknown but non-zero. The 87 million ounce inventory against 500 million ounce open interest, with 98% February delivery rates, creates conditions unlike anything in modern COMEX history. Here's what we know for certain. JPMorgan manipulated silver markets for 8 years, paid $920 million in fines, and sent 2 traders to federal prison. That's not conspiracy, that's court record. CME has halted metals trading twice in 3 months after half a decade without outages, both times immediately before major settlement dates when silver was testing resistance. That's not coincidence, that's pattern. COMEX registered silver has fallen 38% in 4 months, while delivery rates in a non-major month hit 98%. Shanghai physical silver trades at a $12 premium. Lease rates sit at 8% versus normal levels around 0.3%. Mexico supply faces active disruption. That's not speculation, that's exchange data published daily. We're 48 hours from March 1st notice day, with 500 million ounces of paper contracts facing 87 million ounces of physical inventory. That's not fear-mongering, that's arithmetic. The manipulation is real, it's documented, it's ongoing, and it's breaking down in real time. Silver is the most manipulated market in modern financial history. And for the first time since 1980, the institutions that control the manipulation may have lost control of the outcome. If this breakdown gave you clarity on what's building in silver right now, share it with someone who needs to see the full picture before the story is written for them. Drop a comment, hit like, subscribe for updates as March settlement unfolds. The data doesn't wait for anyone. This is financial education, not investment advice. Invest with logic, not emotions, and never with money you can't afford to lose.